Welcome back to Millionaire Headquarters Hub, the place where financial freedom begins. If you're building wealth in 2025 and beyond, you already know the key is diversification. Today, we're shining a light on one powerful, yet often overlooked tool, REIT ETFs. That's Real Estate Investment Trust Exchange Traded Funds. In an age where relying on just stocks or bonds won't cut it, REIT ETFs provide an alternative that can generate steady dividend income and diversify your investment portfolio through real estate exposure without owning a single property. Let's break down what REIT ETFs are, how they work, why they matter, and whether they belong in your wealth building game plan. To understand REIT ETFs, we need to first understand what a REIT is. A real estate investment trust, REIT, is a company that owns, operates, or finances income generating real estate. Think apartment buildings, shopping centers, office buildings, warehouses, hospitals, you name it. REITs are legally required to distribute at least 90% of their taxable income to shareholders annually in the form of dividends. That makes them incredibly attractive for income-focused investors. There are different types of REITs. Equity REITs own and manage income-producing properties. Mortgage REITs invest in mortgages and mortgage-backed securities. Hybrid REITs do a mix of both. Now imagine being able to invest in dozens or even hundreds of REITs at once. That's where REIT ETFs come in. A REIT ETF is a fund that holds a diversified portfolio of REIT stocks. Instead of buying individual REITs, you can buy shares of a REIT ETF and get exposure to multiple segments of the real estate market all at once. REIT ETFs trade just like stocks on major exchanges, making them easy to buy and sell through any brokerage. So what are the benefits of REIT ETFs? Diversification without the hassle. Buying physical real estate is expensive, time-consuming, and comes with responsibilities like property management, taxes, and maintenance. REIT ETFs give you exposure to real estate without those headaches and across many sectors. 2. Steady dividend income. Because REITs are required to pay out most of their income as dividends, REIT ETFs often provide regular, reliable payouts. These dividends can be reinvested or used as passive income. 3. Liquidity and accessibility. Unlike physical real estate, which can take months to buy or sell, REIT ETFs offer instant liquidity. You can buy or sell shares anytime the stock market is open for low investment minimums. You don't need $50,000 to buy a rental property. You can start investing in a REIT ETF with as little as the price of one share, sometimes under $100. 5. Exposure to multiple property types. With a single REIT ETF, you can own a piece of residential buildings, office spaces, and hospitals and senior living facilities. This variety helps buffer against downturns in any single segment. Let's look at a few well-known REIT ETFs that you might consider. 1. Vanguard Real Estate ETF, VNQ, one of the most popular REIT ETFs, offering broad exposure to U.S. real estate sectors. 2. Schwab U.S. REIT ETF, SCHH, a low-cost option focusing on U.S. equity REITs. 3. iShares U.S. Real Estate ETF, IYR, tracks an index of U.S. real estate stocks. 4. Global X Super Dividend REIT ETF, SRET, focuses on high-yielding REITs around the world. Each has different expense ratios, yields, and holdings, so be sure to do your homework before choosing one. With all you know now, here are some things to watch out for. Interest rate sensitivity. REITs are highly sensitive to interest rates. When rates go up, REIT prices often go down. Why? Because higher interest rates can increase borrowing costs and make other income-generating investments, like bonds, more attractive. 2. Tax considerations. REIT dividends are taxed differently than qualified stock dividends. They are usually taxed as ordinary income, which may be higher than the capital gains rate. 3. Market risk. Though diversified, REIT ETFs still trade on the stock market, and their prices can fluctuate with broader market trends. In closing, in a world where market conditions are always shifting, diversification is your superpower. And REIT ETFs are one of the best tools out there to add real estate exposure without the complexity of physical ownership. You don't need to be a landlord. You don't need to flip houses. You just need the right knowledge and the willingness to take that next step in your investing journey. So what do you think? Are REIT ETFs something you're adding to your portfolio? Drop your thoughts in the comments. And if you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you never miss an update from Millionaire Headquarters. Until next time, keep learning, keep investing, and keep leveling up your financial game.